Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Friday, September 15th, 2023, and it has been a whirlwind of activity for several weeks now, rendering me unable to really shoot the typical monthly market monologue. And again, today's video is going to be brief, but wanted to give an update on this TD Ameritrade to Charles Schwab conversion. For the most part, that conversion is done, and from the client's perspective, everything has worked as it should. It was a very smooth process from the client's perspective. From our standpoint, from our side of the line, there's a couple of other things that we're still trying to work our way through, but it has not affected clients. It's just made us work a little harder and obviously get used to new systems and things of that nature. So we are glad the conversion went so well for clients. Now, again, if you have not yet linked your accounts to your spouse's accounts, if you need instructions on how to do that, let us know. I think it was last week, we sent out a detailed email and a video on how you can make sure that you can see your spouse's accounts when you log on to the Schwab platform. Again, we continue to recommend our clients to use our portal and our app if you're on your smartphone or smart device. So that said, we also know that some of you track your accounts through Quicken. And so on the screen right now is an article from Quicken, it's quicken.com, on how to transition your accounts in your Quicken to the Charles Schwab platform. I will provide the link in the description below, and we certainly hope you find that helpful. The next thing I want to talk about today is actually going to be taken from our Market Recon report, which is a weekly research report that we send to a list of advisors that are not affiliated with my firm, but that have subscribed to our weekly research. So this is what we sent out this Monday, and you can see the title of the page is The Magnificent Seven. Obviously a nod to the very famous movies of that name, but in particular this is referring to the top 7 firms in the S&P 500. And what the graphic, and again we'll give credit to Research Affiliates, another research firm, they put together the graphic. Kudos to them. They did a great job on this, and I also love their footnote. I'll come back to that in a second. But in the graphic, you can see that the top 7 stocks, so top 7 companies in the S&P 500, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. Meta, of course, is Facebook, in case you have forgotten. Those top 7 stocks are approximately 27% of the S&P 500. However, look what they have done or how they have influenced the returns in the S&P 500. Now, obviously, we've been talking about this a lot, but this is a really good graphic, and it does a good job of demonstrating what we have been discussing. And you can see that the returns, year-to-date returns from those top 7 stocks have contributed about 12.5% of the S&P 500 return, versus all of the other stocks in the index are only contributing about 4.5%. Now this research is dated June 30th, or this graphic is as of June 30th, but the point is the same, that the top 7 stocks, what have become to be known as the Magnificent Seven, have an over influence on the S&P 500. And so the challenge is it appears that we're in a bull market. It appears that the indexes are going up, and that's really not true. It is still just a handful of companies that are providing that return and pushing that index up. So now we'll switch gears, and we're going to look at 2 different things. This is what we refer to as participation. It's also called breadth. And on the top part of this chart is the S&P 500, and then you can see these next 3 grid lines is the percent of the S&P 500 that is above the 20-day moving average, the 50-day moving average, and the 200-day moving average. And so what we can see is that just barely, as of Thursday, September 14th, just barely 51% of the S&P 500 is in what we call an uptrend. Generally speaking, we defined an uptrend or a downtrend as denoted by whether or not the stock is trading above the 200-day moving average. So as of yesterday, September 14th, only 51% of the S&P 500 is actually in an uptrend. Now, that's the S&P 500. Let's look at the Russell 3000. Again, the Russell 3000 is going to do a little bit better job of capturing a broader swath of the stock market here in the United States. And again, we have just about 44% of the Russell 3000. So approximately 44% of the United States stock market is in an uptrend. So the vast majority, the 56% of the United States stocks, are still in a downtrend. So it appears that the stock market is in this bull market, but the reality is it is still just a handful of stocks that have been participating in this year's rally. Now, if you've been watching our research and watching our channel, you know that we are in a very difficult time period. August and September seasonally is a very challenging time for the stock market. Now, next week, the Federal Reserve is going to be meeting, and they're going to be discussing whether or not they're going to raise rates again. There is some justification for them to raise rates. We have oil is continuing to rise. The price of gas is continuing to rise. The latest inflation report ticked back up. So there's definitely some indications or justifications rather that the Federal Reserve might very well raise rates again. However, the futures market are suggesting that the chances of them doing that actually appear to be pretty slim. So that remains to be seen as to what they will do next week. But seasonally, October, November, December, and then January are some of the four strongest months in the stock market year. And so we still believe that the wind is at our back and the market is going to move higher. However, what we need to see is these participation numbers improving. We need to see more stocks actually participating and beginning to rally above that 200-day and stay above that 200-day, and then we will have all that much more confidence. Just because the major indexes are rallying, that doesn't tell us that the entire stock market is rallying. So we would say this is not really a bull market just yet. We're not in a bear market. We're recovering from a bear market. That's what this year has been very difficult. It's a transition period from a bear market into what we believe. We believe it will be a bull market. We believe there's enough signs underneath the hood, if you will, that the market is healthy, the economy is growing. So far, the recession that all the economists predicted, so far that has not shown up. And again, if you've been watching our channel, you know we've been skeptics on that from the very beginning. Anyway, that's enough for today. Again, hope you find these videos helpful. If you haven't subscribed, we certainly hope you would subscribe to our YouTube channel. If there's anything that we can do, if you have any questions about how we might be able to help you and serve you and your family by either doing financial planning or actively managing your portfolio for you, by all means, feel free to reach out to us. You'll find all of our contact information at hicks-associates.com, and we hope you have a great weekend.